we're looking for companies, first and foremost, that have the ability to persist through time.
First Eagle Global Fund's Matthew McLennan shares his strategy.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Miller Value Partners, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Thanks to a round-the-clock news cycle, the world seems like a very risky place. The markets are reflecting that on a daily basis, but what about longer term? Well, it depends on where you look. This week's guest is a seasoned global investor who is a student of history, economics, and markets, and has been a valued Wealth Track guest since our earliest years. He is Matthew McLennan, head of First Eagle Investments Global Value Team. He is co-portfolio manager of several funds, including the flagship First Eagle Global Fund, which he has run since the 2008 financial crisis. First Eagle Global is rated 5-star by Morningstar and is known for its unusual strategic allocation to gold bullion, willingness to hold cash if stocks are overpriced, and its valuation discipline. As Morningstar writes, this strategy's capital preservation advantages tend to compound over the long haul. Since 2008, the Global Fund has delivered average annualized total returns of better than 9%, broadly matching its benchmark with less volatility, better downside protection, and superior risk-adjusted returns. First Eagle is a current Wealth Track sponsor. McLennan's track record has earned him a place at our table for years. I started by asking McLennan to give us some historical perspective on the current state of the world. How risky is it?
I think we're in a state of the world where risk is better not thought of as being statistical in nature. Think of the normal distribution that many people think they can use to scientifically predict what the tails of the world look like. The reason I say that is that we have what's more akin to a genuine state of uncertainty where we don't even know the exact odds of things. And it's because the forces that are at work today are very multidimensional. On the one hand, given the geopolitical situation in Iran, we have the equivalent of an energy cardiac arrest in the Strait of Hormuz with no traffic passing through. It's like one of those pulse oximeters in ER going flatlining. And that's a risk for the world until it's resolved. Aside from that, we entered this moment actually at a moment of fairly low risk perception in the world, in the sense that credit spreads in the US, if we look at the high yield universe of credits in the United States, were close to their lows that they were trading at in 2007. And so when an actual risk manifests itself and the markets aren't pricing a lot of risk, that produces the prospective problem of disappointment at some point if things don't play out smoothly. And I think the final thing that really just adds to this dynamic, aside from the geopolitical and the market level of pricing as we've gone into this moment, is that we have relatively unmoored fiscal settings globally. And that can have a lot of complicated second-order consequences long-term. So all of these things together produce more of a state of uncertainty than measurable risk as we look at the world today.
Is there an equivalent time in your experience as a money manager?
This is a moment where we've seen essentially a change in the underlying equilibrium of the world geopolitical order. On the one hand, you have an alignment between China, Russia, North Korea, Iran, which covers well over 1 billion people. And then the United States on the other side, with somewhat of a fracturing relationship with its traditional allies in Europe. And so that dynamic is quite different from where we were 20 years or 30 years ago. In fact, I remember back in the 1990s, the Washington Consensus reigned supreme in the world. And I think the dynamic is quite different today. It's much more complex. And so to that extent, it is different. Now, we've had events along the way, from 9/11 to global financial crises and COVID, that have all been tail risks, if you will. So the fact that we have one specific event today has to be looked at in the context of that history and the resilience of the system over time in the face of those kinds of risks. But the underlying constellation of geopolitical forces is different this time. The underlying fiscal reality for the sovereigns of the world is different this time. And so those are the things that make it more unquantifiable in my mind.
Matt, for people who are not familiar with First Eagle, could you explain what First Eagle's approach is to building portfolios?
Well, true north for us is resilient wealth creation. And the first component of that is to avoid the permanent impairment of capital wherever possible. And it's interesting, we started out this conversation talking about some of the risks that are prevalent in markets on a top-down basis. The way we address that is not to try and construct our portfolio with top-down themes, but rather we try to seek resilience bottom-up, one security at a time. And that means that we're looking for companies, first and foremost, that have the ability to persist through time. There's something special about their incumbency in a marketplace. They might have high market share or unique R&D or brands, or there's something special about the assets they own, well located, very long duration. Ultimately, if there's scarcity in the business, that business has the ability over time to generate cash flows. They might be cyclical, but the ability to generate cash flows over time is the cornerstone of resilience in our way of investing. And I think the other thing that's equally important is that when we find these opportunities one at a time, we only look to deploy capital when we believe there to be a margin of safety in price. So it's not enough to identify a scarce asset or a scarce market position. You have to do so when the market doesn't perceive it as such. And thus, you have a margin of safety in price. And when we put those together, bottom up, we call it scarcity value. And we have about 80% of our portfolio invested in businesses around the world. But we do have some potential ballast in the portfolio, and that's split between gold as a potential hedge and cash that we can use as deferred purchasing power. And that tends to be just under 20% of the portfolio.
One of the things that I mentioned in my introduction to you is that one of the really unusual aspects of your portfolio construction is that you always have a position in gold, in bullion, and sometimes gold stocks if they're attractively priced. So right now, what is the position in gold and also in gold stocks?
So if we combine our bullion investment with our gold miner equity investments, it's around 14 to 15% of our portfolio. And we've been careful over the years, even though we value having a meaningful and material potential hedge in the portfolio, that it not become a directional driver of our portfolios. And so typically, when gold price has been very strong, as it has been over the last year, episodically we've trimmed that position and taken some of the gold to invest in equities that we think are out of favor. On the other hand, many years ago when the gold price was very depressed, we were a net purchaser of gold. Otherwise, that potential hedge would have been too small in our portfolio. And the reason we've chosen gold as a potential hedge is that we view it as the most defensive real asset. It's not something that can be printed. There's a fixed amount of it in the world. In fact, it's quite a small amount, less than 1 ounce per capita. You could fit it all into a cubic tennis court. If you took all the gold that was in jewelry, central banks, ETFs, and personal holdings, it would fit into that small space. And the way we think about it is it's like defensive land. And people will bid for it based upon risk perception. And even though it doesn't have a yield, over time, because of its scarcity, it has gone up in value over time as the nominal level of wealth in the world has gone up over time. And so we hold it as that long-term potential hedge in our portfolio. Now, there could be a state of the world if markets were very depressed for an extremely long period of time, like the late 70s or the late 1930s, where we would take that gold and invest more readily into stocks that we like at very discounted prices. And so it could fall to a single-digit percentage of the portfolio, but right now it's in the 14 to 15% range of the portfolio.
You mentioned the scarcity values. Can you share some examples of companies that kind of epitomize that scarcity value that you've held in your portfolio? And you do tend to hold some of the securities for a pretty long period of time.
That's for sure. And so I think you have to disentangle those companies that have scarce real assets from those companies that have scarce intangible assets. Now, real assets in some ways are easier to understand. It could be centrally located real estate. So think of a large REIT like Equity Residential, EQR, that has one of the largest portfolios of multifamily real estate throughout the United States. As interest rates have gone up, that security has derated. Even though the underlying cash flow stream is real, it's been treated in markets as if it were nominal. And so you're getting higher dividend yields in the REIT space now than you have for quite some time. Beyond real estate, there are many companies that control essential infrastructure in terms of real assets. And that could be a company like ONEOK, which controls the largest network of midstream pipelines throughout the United States to transfer refined products and NGLs. Or it could be a company as simple as Comcast that has a hard-to-replicate network of coaxial cable in the ground for over 30 million subscribers. And so there's a range of real asset investments that we have in our portfolios, but there's also companies that control intangible assets. And what are those? I mean, it could be, for example, a company that has a very strong local market network effect. And so an example of a company like that would be FEMSA in Mexico that controls over 20,000 OXXO convenience stores. It's larger by order of magnitude than any other convenience store operator in Mexico. And if you're a consumer brand wanting to tap the Mexican market, you have to come through that OXXO network. So it's essentially a royalty on stable consumer expenditure in Mexico. But then there are other types of intangible assets. Think of iconic brands. A company that may have been around for, that owns a brand that's been around for a century. And I think of the holding company for Cartier, for example, Richemont. Cartier is a century-plus brand, which gives it a certain amount of pricing power through the cycle. And then there are other kinds of intangible assets that we find very valuable, such as companies that have mastered a precision process or product. And you could think of that, a big company like Medtronic, for example, that is the world leader in defibrillators or pacemakers, or a company as quirky as Hoshizaki, which is a Japanese company, which is the world leader in commercial ice machines. So whenever you go to a restaurant or a sports arena, you're likely to come across a Hoshizaki ice machine for your cold beverages. And so we look for these kinds of businesses, whether they own real assets or whether they have hard to replicate market positions, and we wait for them to become available at the right price.
Right now, the global fund is underweight the United States. In other words, your position is below the benchmark. What, it's less than 50% of your portfolio is in U.S. equities. Again, you don't do top down, you do bottom up, but that's the way it's played out. Yeah,
it's played out bottom up that way, in the sense that if you look at the plus or minus 80% of the portfolio that we have in equities, just under half of that, so under 40%, is in the United States. Now, if we look at the MSCI World as an index of world equities, it's over 70% in the United States. And so the equity markets are very concentrated in one country, and within that, very concentrated in one sector, technology. And that's been the story of markets historically. They tend to get quite concentrated. People think of owning an index as being low risk, but sometimes it exposes you to great pockets of concentration. It did that in the late 80s in Japan. Japan was the largest country in the MSCI World just before it imploded. Tech in the late 90s was the largest. So one has to be a little careful when just looking at the indices, because sometimes there are undue concentrations. And when you're looking bottom up though, and you want to bring some intentional variegation to the portfolio, some intentional non-uniformity to your portfolio construction so that you're resilient to a lot of different states of the world, it leads you to be more open-minded to investing in different markets, different geographies, broader sectoral representation. And so when you look at our portfolios, they're quite a bit more diffuse in terms of geographic exposure and industry exposure than the underlying markets themselves.
And yet, Matt, two of your largest holdings, and again, you don't have enormous holdings in any individual securities, but are two Mag 7 members, Alphabet, and also Meta. So those are two holdings of yours. So how do you reconcile what kind of you just told me about the U.S. market concentration and still holding those two companies.
I mentioned before FEMSA as an example of a company that has a network effect in a market like Mexico. Meta and Alphabet are examples of companies that have a network effect, but in a virtual space. They're two of the very few companies in the world that have billions of customers, not tens of millions, but billions of customers. In order to understand how they're present in our portfolio, you have to go back in time a little bit. We made our investments in Alphabet and in Meta when they were out of favor for one reason or another. In both cases, we were able to deploy capital at a mid-teens multiple of earnings, not revenues, when we bought into those securities. And so it was an example of companies that controlled scarce networks, but where we had a margin of safety and price. And then as they performed, they became larger positions in the portfolio. And indeed, when they got to more extreme valuations, we recycled some capital from those names into other investments. So otherwise, they would have become much larger in our portfolio. So they're there for a reason, and they sit alongside other investments, though, that may be less in favor. Such as software investments in technology or investments in energy until recently, or investments in healthcare. And so there's a kind of a barbell within our portfolio. We want a foot in the new economy, but we're totally open-minded to old economy assets that have duration and sensible valuations.
How are you handling the phenomenon of AI?
I actually, I'm quite enthusiastic about AI as a tool. I remember when Wikipedia first came out, I loved it. I was always a fan of encyclopedias as a kid. And the ability to kind of index knowledge efficiently is something that just appeals to me. And so Wikipedia was great, and now these search engines are great. But I think you also have to recognize the limitations of these search engines. They're essentially predictive devices. It's predicting what word is likely to come next based on all the words that are out there. You get some strange hallucinations that occur from time to time, but I do think that AI is transforming in some ways. One of the things I would share with you, though, is that there's a lot of generalization going on in the market today about the impact of AI. It's going to disintermediate everything. It's going to disrupt everything. I think our perspective on this is that what's going to matter more and more is the extent to which companies not just have strong market share positions or hard to replicate assets, but the extent to which they have unique proprietary databases. Because all of the LLMs that are out there today have essentially been trained on scraping the publicly available content of knowledge that's on the web.
Right, the large language models, right.
The large language models. In order for them to transform businesses, they need to be applied and do inferencing on proprietary data sets. And so for companies that control large proprietary data sets, they could be huge beneficiaries of AI. On the other hand, if you're a business that's just tapping into publicly available information, you may face some disintermediation risk from some of these. And so we think that the market will become more discriminating over time in terms of which companies are beneficiaries and which companies are disrupted. Right now, the market's just fearing a broad-based disruption.
So based on that really interesting observation about the proprietary data, or the proprietary nature of data, you know, what's in the public domain and what's not. So Alphabet and Meta qualify, right, as having proprietary data that would benefit?
In a sense, Alphabet and Meta have the benefit of already having billions of customers. And so they're able to invest in creating large language models, the LLMs, that will actually get an economic return because they'll drive better search activity if you're Google, or a more tailored experience if you're going on Instagram, where your preferences are better inferred by the AI. So they have the ability to amortize the cost of those investments across a lot of customers and drive improvement in the customer experience and therefore a degree of pricing power. There are other companies, though, where the market perceives them as being victims. And I would think of some of the sell-off in, say, the SaaS software space, companies like Salesforce, for example, or Workday. The market is quite worried about those businesses going away. On the other hand, when we look at those businesses, we view much of their software as being mission critical to companies. And those companies, because they touch the majority of Fortune 500 businesses already today, really are in control of the database of things that matter. If you're doing payroll-related software, well, it really matters that you understand the regulatory environment that you're in and that you have very precise mechanistic inputs into that software, not a predicted word, but very precise, because you have to comply with the law. Or if you're running a large
so that's Workday.
And Salesforce is the leader in CRM, which is the marketing software basically. If you have all of the data on customers and preferences, you're starting from an advantaged position in being able to use LLMs to provide what they refer to as an agentic experience for your customers. So it could actually add a layer of incremental revenue rather than just taking the business away.
Your least favorite question of every Wealth Truck interview, Matt McLennan, the one investment for a long-term diversified portfolio.
Well, I think it's important at a moment like this where we're in the middle of a war, we're in a ceasefire, where we don't know exactly what's going to happen, not to necessarily be making an investment that depends on a specific outcome. So I'm going to give you two investments, one in the United States and one outside the United States. The kinds of companies where you're not making a bet on the macro economy in the short term, but you're identifying a business that can produce cash flows over the long term. And so an international name that you'd be familiar with is Nestle. Another business which probably has over 1 billion customers, from Nespresso to Kit Kat, Purina pet food, and let's not forget their 20% ownership in L'Oreal. These are iconic brands and they're day-to-day staples. So it's a cash flow generative business that doesn't experience a lot of cyclicality, that today is quite depressed relative to where it's traded historically. The company itself has close to a 6% prospective free cash flow yield. And it can return most of that to you through dividends or stock repurchases, and it's being managed for the long term. One final investment I just mentioned as a US equivalent company, even though the markets in the US have been more expensive, healthcare has been out of favor. And so one of our largest investments in the United States is a company called Becton Dickinson. And Becton Dickinson has over half the global market for syringes and catheters. So every time you go to a hospital, you're likely to touch a Becton product. It is the ultimate staple in the world of healthcare. And because healthcare has been so out of favor, the stock has derated quite a lot. And in fact, they've improved the business. They spun out in a reverse Morris Trust, their diagnostics business. So it's really focused now on being the world leader in syringes and catheters. And it trades at about 12 to 13 times earnings, all of which could be free cash flow. So you're talking about the potential for a 7 to 8% free cash flow yield, and a company that's paying a healthy dividend, buying back stock, and a very stable business over the long run.
Matt McLennan, thanks so much for joining us once again on Wealth Track and providing your wisdom and your perspective on both the macro level and also the individual company level. We really appreciate it.
It's wonderful to see you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. Our guests have been making some suggestions as well. We've been asking them to share the best investment advice they have ever received. This week's action point from Matt McLennan: be a patient investor.
It definitely came from Jean-Marie Eviard, who managed the First Eagle funds for many decades before I had the privilege of joining First Eagle. And he reminded me that when you think about patience in investing, it's very multidimensional. I understood intrinsically as an investor that the idea of investing is to buy a good business at a sensible price. And you might have to wait a decade to get a good business at a good price. But Jean-Marie highlighted a few other elements of patience that are incredibly important as an investor. One is that if you've identified and owned a good business that you think is a compounder, you should be a patient seller as well, because they're very rare. And so I think Jean-Marie helped me extend my time horizon of ownership, because he wasn't just a patient buyer, he was a patient seller. And I think the second thing that he reminded me of is the psychological dimension of investing that's so important, which is that you have to be patient in the sense that markets may not favor what you do for long periods of time. And most people shrink from that sort of psychological pain, if you will, of being out of favor. And I think Jean-Marie was always very important to us because he would encourage us to stick to our process and stick to our convictions, despite discordant signals you might be getting in the markets. He refers to it as that every investor has to make their own crossing of the desert. When I reflect on the value of patience overall as an investor, what else is in shorter supply than patience? And I love what the French playwright Molière said. He said, the trees that are slowest to grow produce the best fruit. And I think there's some wisdom in patience. And Jean-Marie, I give a lot of credit to for being a lifetime exemplar of that value.
So many of WealthTrack's great investor guests have advised having patience, holding on to their best businesses, and letting them compound over time. It is not easy to do in today's fast-moving, high-pressure world. Next week, award-winning strategist Richard Bernstein explains why investors need to change their portfolios to reflect new market realities. Please follow us on Facebook, X, and our YouTube channel. Thanks for spending time with us. Enjoy your weekend and make the week ahead a healthy, profitable, and productive one.